So overall growth in the U.S. has remained fairly good. It's slowed down from 2024, but it's still about 2% in our estimate for 2025. But the place where you can see that reduction in the labor supply is if you look forward and you think about what is the potential growth for the U.S. And that estimate, of course, is very imprecise, but our estimate of potential growth in the U.S. has been revised down as well, and that's reflecting that lower contribution from a foreign labor force that was quite significant in previous years, and we're not foreseeing that it will continue to contribute. Now, the other side of this is what does it do to the rest of the world? Well, obviously, if you have slower growth in the U.S., per se, it's not a good thing for the rest of the world. There are spillovers that are coming from when an economy like the U.S. is growing strongly, then it generates demand for other parts of the world as well. So something that is contributing to a slowdown in U.S. growth is, in general, not something that is going to be good for the rest of us. The growth in the Chinese economy in the last few years has been coming in significant part from the external sector. But what we are seeing there is something interesting, which is we see an increase in volumes that are being produced, but we see increasingly a decline in the prices at which they need to be sold on markets. And that suggests that somehow the market has a limited capacity to absorb all of that is being produced coming out of China. And that suggests that that growth engine, that second growth engine itself is starting to face difficulties. So our advice to the Chinese authorities has been for some time now, it's been for many years, if you look back at our Article 4, there is a need to rebalance the growth model towards a sustainable domestic demand.